The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Welcome to today's webinar presentation. I'd like to thank everybody for joining us here today. My name is Anthony Pavlik, District Sales Manager and Media Consultant for Gardner Business Media. Today we'll be reviewing the 2015 forecast on capital spending, which details our audience's purchasing intentions for capital equipment, tooling, and work holding. Today we will be recording this presentation and will provide everyone who registered with a link to the recording just after the event so that you may review or share this information with other members of your buying team. Before we begin, if anyone has a question or a comment during the webinar, we'd ask that you simply type your questions into the messaging area of the GoToWebinar box located on the right portion of your viewing screen. And we'll answer those questions during a live Q&A if there's time at the end of the presentation. Our presenter today is Steve Klein, Jr. Steve is the Director of Market Intelligence for Gardner Business Media. Steve has participated in AMT's Global Forecasting Conference since 2008. Steve is a graduate of Vanderbilt University with a Bachelor of Science in Civil Engineering. Also has an MBA with an emphasis on finance from the University of Cincinnati. With that, I'd like to turn things over to Steve.
Thank you, Anthony, and good afternoon to everybody. Today we're going to look at the results of our capital spending survey as well as a forecast that I put together for machine tool consumption. And if you were at IMTS, you probably saw that our capital spending survey was indicating an increase of 37% for 2015. For machine tool consumption. And so what we want to do today is provide some context into that forecast, into that survey and the survey results, and give you an understanding of whether that's even realistic or not, and hopefully help you make some judgments on how realistic you believe that to be. So we'll jump into the presentation. And the first slide that I want to show you here is kind of the economic cycle of capital spending. And these are the various data points that I track throughout the economy that all point towards capital spending, and that's our goal here is to forecast that. And so you can see on this chart the cycle of the economy moves from left to right, starting with exchange rates and interest rates, and it moves towards the right-hand side, real capital spending. And at the top we have the months that are in the cycle, and so it takes exchange rates and interest rates about 39 months on average to affect real capital spending, or you can see that it takes exchange rates about 18 months to affect the money supply, and so on. So all of those arrows indicate that the previous data point is a leading indicator for the one that it is pointing to. So real interest rates, for example, are a leading indicator of real construction spending, and real construction spending is a leading indicator of industrial production, and so on. So this is a very handy way of kind of keeping track of what's going on in the economy. And even outside of today's presentation, I would encourage you that anytime you are hearing a presentation about economics, reading an article about a particular data point, try and put it into the context of this chart, and it'll help you understand how different data points are affecting each other and how ultimately that they affect your business. So looking at a very high level, we're looking at global machine tool consumption and production here. The red line is world production, and the blue line is world consumption. And this data comes from our very own World Machine Tool Survey that we do. We do this survey annually, and typically it's finished at the end of March, beginning of April timeframe. This data is gathered from machine tool associations around the world, so AMT contributes data to this, as well as JMTBA, the Japanese Machine Tool Association, CMTBA in China, SESIMO throughout all of Europe, VDW in Germany, and a number of others around the world. Each of the years on this chart represents the top 25 consuming countries in that particular year. So the countries, the 25 countries in any individual year may be different, but they are the top 25 countries in that year. We figure those 25 countries represent about 95% of the world's machine tool consumption. Now, there are some countries that we're missing, particularly in Southeast Asia, that would have a chance to be in the top 25 countries, such as Thailand, in Indonesia, and perhaps Malaysia. Those countries, unfortunately, do not report their production, so we cannot calculate their consumption. As you can see on this chart, I'm forecasting about a 4% increase for world consumption next year, a slightly slower rate of growth than what I think we're going to see in 2014, which is about a 6.5% increase. You'll notice that production is always higher than consumption. The red line is always above the blue line. The gap between those two represents inventory, and you can see that inventory is significantly higher on the far right-hand side of the chart in recent times than it was before, but that's because overall machine tool consumption is higher, and it takes a higher level of inventory to support that. So to forecast 2015 production, I just assumed the same rate of growth as consumption, about 4%. And if you go back historically and look at the rate of change of production and consumption, they always track each other almost exactly. So that assumption is a pretty valid one. Now, if we drop down a level from world consumption and production and just start to look at regional machine tool consumption and looking at North America, Europe, Asia, and South America, you can see that Asia is clearly the largest region for machine tool consumption, followed by Europe, then North America, and you can see South America is way down. And South America is essentially made of two countries, Brazil and Argentina. You can see that Asia has fallen down a little bit in its consumption since 2011. Europe is relatively flat over that time period, but since 2010, North America has been steadily growing and pretty much the only region that has been growing throughout that time period. One other point that I didn't mention on the previous slide for this particular data, this is both metal cutting and metal forming machine tools. So we're not looking at just metal cutting here. As you can see, for 2015, my forecast is for both Europe and Asia to be relatively flat. Europe up about 1.3%, Asia down about the same amount, 1.3%. But North America, I'm forecasting almost a 25% increase, up about 24%. I arrived at that forecast for North America if we assume that total machine tool consumption is going to be up about 30%, slightly less than the metal cutting side, or perhaps not quite as good growth in metal forming. So U.S. up 30%, and Mexico up 10%, and Canada up 10%. And we'll get into some specific countries in a minute. But so you can see that North America is really going to be the one spot in the world, the one region in the world that is going to have significant growth. This chart is showing us the top 5 machine tool consuming countries. For the last several years, China has been the #1 machine tool consumer in the world. Now, China reports significantly higher levels of consumption than what I'm showing here. However, they report both production and consumption for non-CNC machines. And so I've adjusted the Chinese data to remove the non-CNC machines because almost everybody else in the rest of the world, almost every other country, only reports CNC machines and only uses CNC machines. China's data, therefore, is overstated by quite a bit. And we've reduced the Chinese production numbers to 33% of what they report. That means 67% of their production is non-CNC machines. Now, of the 33% they report, a number of those machines are still digital readout machines or machines with a very simple control on them. So even within the part that they consider CNC, it's still not a true apples-to-apples comparison of what we would see consumed in the other countries around the world. But at least it gets us closer and in the ballpark. So you can see that with the U.S. Increasing 30% in this chart, it's going to be the first time potentially that the U.S. would be the #1 machine tool consumer in the world since the year 2000. This is assuming China's machine tool consumption decreases by about 10%. You can see Germany in third place, as it has been the last several years, forecasting a slight decline, but still relatively high compared to any time back to the early 90s. Japan seeing a little bit of an increase the last couple of years, but relatively low consumption compared to the period from 2004 to 2008. And then South Korea up slightly and looking like it'll have its second best year regarding consumption. Now, if we look at some individual countries, and what we're going to look at are leading indicators for those countries, and we're going to be looking at the money supply, capacity utilization, and industrial production. And for China, unfortunately, we don't have capacity utilization. We only have industrial production. But for 2014, I'm forecasting a flat year for China and then down 10% in 2015. As you can see, the money supply in China is the solid red line there, and it is growing at a slower and slower rate recently. Since March of 2012, Chinese money supply has been growing less than 10% on an annual basis. And this is the first time that has happened since 1990. So for almost a little more than 20 years, China's money supply has been growing by more than 10%, and that's one of the reasons why their economy has been expanding the way that it has with the level of debt that's been taken on there. Also, we can see that production is growing at its slowest annual rate since September of 2009, almost for 5 years now. And at the current annual rate that we're seeing China's industrial production grow, there's only been 5 times since 1995 when that annual rate of production growth has been slower. So 2 of the leading indicators here for China that we can see are growing at a slower rate and will probably continue to do so, and therefore we're forecasting a decline in China's consumption. If we look at Germany, we can see the solid red line, the money supply. It's decelerating, and it has been since June of 2013, and it's growing at its slowest rate in nearly 2 years. Capacity utilization in Germany has been growing at an accelerating rate, and it's growing at its fastest rate since April of 2012. But when you look at the month-on-month data and the capacity utilization in Germany, it's indicating that the capacity utilization is getting ready to see its peak rate of growth and should begin to slow down here in the next month or two. Importantly, in Germany, the production index, the latest production index that was released came out in August of this year, and it is the lowest level of production in Germany since August of 2009. It's also the 3rd lowest level of production in Germany since January of 1995. So production is actually quite low in Germany at the moment. And month over month, comparing August to August 1 year ago or July to July 1 year ago, Germany's industrial production has contracted 4 of the last 5 months. And it's likely before the year is out that Germany's industrial production will begin contracting. So we have the money supply growing at a significantly slower rate, capacity utilization looking like it's ready to start growing at a slower rate, and likely production will be contracting by the end of the year. Therefore, we're forecasting a decrease in Germany's machine tool consumption of 8%. Japan, we've seen a steadily accelerating rate of growth in the money supply, although it has peaked in recent months and begun to slow down the last couple of months. Capacity utilization in Japan is growing at its fastest rate since April of 2012, although it also has peaked and been slowing down the last couple of months. And the production index in Japan is at its lowest level since its lowest level in several months. You can see the month-over-month change in production has contracted the last 2 months by 3 or 4%. So Japan's production is slowing down at a fairly rapid rate, and the annual rate of growth in production has decelerated for the last 2 months in Japan. So while Japan is still seeing relatively strong annual rates of growth in the various leading indicators here, they all are starting to peak or getting ready to roll over. Therefore, we're seeing Japanese machine tool consumption up significantly in 2014. I think it'll come in a little less than the 40% that we're showing here. More likely it'll be 25 to 30%. and then we'll see a slower rate of growth next year, somewhere around 6% for Japan. South Korea, the money supply has been growing at a relatively rapid rate in South Korea. However, the month-over-month growth in the money supply is at its slowest rate since April of 2013. Therefore, we've seen the money supply starting to roll over, and it's just now starting to grow at a slower rate. Capacity utilization and industrial production have been virtually flat since the beginning of 2013 in Korea. In fact, the month-over-month growth in capacity utilization in Korea was the slowest since at least November 1994. That's as far back as the data goes for capacity utilization for Korea. Also, industrial production month-over-month has contracted 2 out of the last 4 months, and as I said, the annual production growth is virtually flat. So we're seeing some rolling over in the money supply, slower growth starting to happen there, and really pretty weak performance in capacity utilization in industrial production, and that's going to lead to a slower rate of growth in machine tool consumption in Korea next year, with it increasing just about 2% or so. So for all these countries that we've looked at, China, Germany, Japan, and Korea, basically we're seeing the leading indicators starting to roll over or have been slowing down significantly for some period of time. But it's a different story when we look at Mexico. Mexico is seeing all of its leading indicators begin to improve. The money supply has been growing at double-digit rates since December of 2013, and the annual rate of growth in the money supply has been accelerating since November of 2013, and it should continue to do so for at least several more months. The capacity utilization in Mexico, the month-over-month rate of growth has increased 3 of the last 5 months. So even though capacity utilization at the moment is contracting, it is doing so at a slower and slower rate every month. And very soon we should see capacity utilization accelerating on an annual basis, growing faster and faster each month. The production index has also been growing. Production in Mexico is at its 2nd highest level ever. So while in Germany we're seeing production at its 3rd lowest level in at least the last 20 or 25 years, we're seeing just the opposite in Mexico. Month-over-month production has been growing for 13 straight months, and the annual rate of growth has been accelerating as well. And so all of these are going to lead to stronger machine tool consumption in 2015. So while it looks like 2014 will see a slight contraction, we should see approximately 10% growth in Mexico in 2015. For those of you that might not be familiar with our capital spending survey, just to remind you of that, our survey forecast plan spending by machine type, by industry, and by region and plant size. All of those forecasts that were created and projected across plant size. Plant size is the controlling factor or the controlling demographic when you look at what plants are going to spend on capital equipment. It is the one demographic that has a high correlation to an actual plant's spending. The surveys, we sent them out to Modern Machine Shop, Production Machining, Mold Making Technology, and Automotive Design and Production. For our machine tool survey, we sent out 28,000 surveys, and for the tooling and work holding survey, we sent out 10,000 surveys. Those surveys went out in mid to late July, and the results were completed sometime around the middle to the end of August. As always, we like to show you our forecast accuracy. The red line on this chart is the accuracy of our machine tool survey or the equipment survey. If you exclude 2002 and 2009, since 1995, we've had an error of plus or minus 13%. We exclude those years because there was a dramatic change in the economy just after the survey for those years was filled out. So in 2011, of course, we had 9/11 happen, which was 2 months after the survey was filled out. And in 2008, we had the housing bubble burst, and Lehman Brothers collapsed again about 2 months after the survey was complete, which then meant that the 2002 and 2009 surveys were going to be wildly off because people dramatically changed the expectations of their spending. Our tooling and work holding survey, that's the blue line on here, we're about double the error rate on that, although you can see most of that came from the 2002 to 2005 time frame. I think we've got the survey working better and using a more statistical process to calculate those results. And then finally, you can see the error of my particular forecast, my personal forecast that I do, which is the GBM unit forecast there. And you can see that for 2014 year to date, I'm off about 1% at the moment. And 5 of the last 7 years, my forecast, my personal forecast, has been more accurate than the capital spending survey. So now we're looking at U.S. machine tool consumption. This is just metal cutting machines. And you can see on here our forecast of $8.8 billion for 2005 based on the results of our survey. That'll be the highest year in machine tool consumption since 1998 when we were at $9.8 billion, so still $1 billion less than the previous peak in machine tool consumption. You can also see that it's significantly higher than average machine tool consumption, which is just over $6 billion in a given year. Also, 2015 looks like it'll be the 3rd highest year since 1980. What's important to point out and to help put this increase of 37% into context is that 14 times since 1937 we've seen machine tool sales or machine tool consumption increase more than 37%. So 15 to 20% of the time, machine tool consumption goes up more than what we are going to forecast or what we are forecasting for 2015. Now that's not 15 to 20% of the years when consumption goes up. That's 15 to 20% of all years we see consumption go up more than 37%. And in fact, if we look at the years where machine tool consumption increases, the average increase is 30%. So we're only projecting a slightly more than average increase in machine tool consumption based on the results of our survey. It's also true that we don't see a 37% or more increase off of just really low years. So when machine tool consumption was really low in 2009, well, sure, we're going to see a big percentage increase in 2010 or 11 when the market starts to pick up again. But if you look at those peak years from 1965 to 1980 or so, in every one of those years, or every one of those periods and during those peaks, machine tool consumption grew significantly at the peak, upwards of 25 or 30% or more. So it's not uncommon to see a very significant increase heading into a peak. This is looking at tooling and work holding consumption combined here because that's the way the government reports that data, so this gives us a helpful comparison to government data. Our survey for tooling and work holding combined is about $4.8 billion. You can see that's above the historical average, and it's going to be the best year since at least 2002. Total increase for those two categories is 7% in 2015, but if we look at tooling separately, we're looking at about a 10% increase, and we're looking at about a 2 or 3% contraction in work holding. So we're looking at about $3.4 billion spending on tooling and about $1.4 billion spent on work holding. And we're going to look at several leading indicators for the U.S. here, and we're going to look at them in what I think are the order of importance. So the first one we're looking at is the monetary base. That's the red line on this chart. Currently, we're right near the peak at the far right-hand side of the chart there, but the Federal Reserve has said it's going to end quantitative easing this month, and if we assume the monetary base stays flat, the actual monetary base stays flat going forward and through 2015, we're going to see the monetary base decelerate as that red line is doing there. You can also see our forecast for machine tool consumption, as we showed before, up 37%. It might be a little hard for you to see on this chart, but also on there is my forecast for units and dollars for 2015. I think we're going to see both units and dollars, according to USMTO, end the year up about 12 or 14% in 2015. However, during the year, I think unit growth, the rate of growth in units, will peak about 14% in the August-September time period, but dollar sales will peak close to 20% also in the same time period of August and September. So we've seen weaker performance in dollars in 2014 compared to units, but I think that's going to reverse itself, and dollars are going to catch up and surpass units in 2015 as the market begins to consume more, machines get harder to acquire, and therefore the price starts to go up. This chart is looking at backlogs and their relationship to durable goods capacity utilization, and the red line is the rate of change in backlogs according to our metalworking business index that we do every month. And you can see that the backlog index has been improving significantly since 2013, and since the beginning of 2014 it's been growing at a faster and faster rate every month. As you can see on here, it's a very good leading indicator of the rate of change of durable goods capacity utilization. In fact, backlogs lead capacity utilization by about 7 months. My forecast for capacity utilization is that we will reach 80% before the end of the year, which will be the first time we've hit 80% capacity utilization in the United States since June of 2000, and I actually think we're going to probably average above 80% for 2015, which will be the first time that has happened since 1998. So it looks like capacity utilization should continue to improve going into next year. And this is very important for machine tool consumption because capacity utilization is an excellent leading indicator of machine tool consumption. It tends to lead consumption by about 10 months. My rate of change forecast for durable goods capacity utilization is for it to go over 4% sometime around the second quarter of 2015. Every time machine or a durable goods capacity utilization has grown at a rate of 4% or more, we've seen at least a 16% increase in machine tool consumption. So this is a very positive sign for machine tool consumption next year. We can also plot the annual average capacity utilization and correlate it with real machine tool consumption. And so here we're looking at average annual capacity utilization on that horizontal axis, machine tool consumption on the vertical axis. And I've highlighted where 80% on the vertical green line there and the horizontal green line at $8 billion, because we're looking at consumption to be kind of in that upper right area of the chart there. And you can see most of the time that we hit an annual average capacity utilization of 80% or higher, most of the time machine tool consumption is more than $8 billion. In fact, it's about 60% of the time that happens. And even if we average slightly less than 80% capacity utilization, it's still quite possible to have machine tool consumption above $8 billion. Now, if you're familiar with this chart and our presentations in the past, you know that years tend to group themselves in overconsumption, being above the red line, being above optimum demand, or they fall below the red line or optimum demand, and we have underconsumption. If 2015, if our survey is correct, that will be the 7th year in a row of overconsumption. That would be the longest streak of overconsumption that we've seen. Now, we've seen a period of underconsumption that's also been 7 years. So it looks like we're going to start seeing, after 2015 for sure, underconsumption in the market. So for a given level of capacity utilization, the points will start falling below that red line. It's also important to note that we've had 4 years where we've had more overconsumption than what we're forecasting for 2015, and you can kind of see those points all fall above the $9 billion mark there. So it is possible for things to go even beyond what we're forecasting for 2015. Our own business index is also a very good leading indicator for machine tool consumption and machine tool sales. It tends to lead actual consumption by about 10 months. Just like our backlog index, you can see that the rate of change in our business index has been improving significantly since the beginning of 2013 and has been growing at an accelerating rate throughout 2014. We probably have a couple more months of accelerating growth in our business index before it starts to tip over later this year. And finally, we can look at durable goods production. I think we're going to see an accelerating rate of growth through the end of the year in durable goods production and into 2015, and then we'll see the rate of growth in production start to slow down a little bit. But production tends to lead machine tool consumption by about 15 months. And so once again, this is pointing to very strong machine tool consumption in 2015. In fact, our durable goods production index is at the highest levels it's ever been in the history of the country. So just like Mexico, we're seeing record levels of industrial production. Now, why are people buying machines? Well, the number one reason the last 4 or 5 years has been buying a machine to increase capacity, which is the red line on here. And you can see that we've been above 50% for the last 4 years, and in fact we were above 50% for 5 years during 2004 to 2009. So this is clearly the number one reason to buy. It's the only reason to buy that has not been on a steady decline since the mid or early 1990s. Also important is the green line on here, a machine to increase process flexibility. You can see that's been stabilizing over the last 4 or 5 years, although we did see a run-up in 2012 and 2013. So this is still an important reason for companies to buy, just not quite as important as a couple years ago. Now looking at the major metal cutting categories, if we look at the first 3 machine types on here, machining centers, turning centers, and lathes, we can pick out some trends in 2015 relative to 2014, and those trends are that there is better growth or more consumption expected to happen in turning over milling, in smaller machines over larger machines, and in vertical machines relative to horizontal machines. So those are general truisms going into 2015. In fact, what we're seeing in 2015 is that spending on vertical machining centers and horizontal machining centers is going to be roughly even for the first time since 2012. And within vertical machining centers, the spending is going to be split relatively evenly between larger machines and smaller machines. But in horizontal machining centers, the machines with a less than 400 millimeter pallet are going to see significant growth, but those with a larger than 400 millimeter pallet are going to see contraction. The turning center market is almost all horizontal. It's about 90% horizontal turning centers and 10% vertical turning centers. But within those horizontal turning centers with a less than 10-inch chuck are forecasted to double, but those with a greater than 10-inch chuck are going to be relatively flat. The vertical lathe market is expected to double next year, except the vertical lathe market only makes up about 13 to 15% of the total lathe market. But we're going to see significantly stronger spending in small horizontal lathes relative to large horizontal lathes, again, the 10-inch chuck being the breakdown between those two. Within the grinding category, we can see significant growth in grinding since 2010. There are 4 categories that are going to be roughly between $125 and $150 million of spending within grinding. Those 4 categories are cylindrical external, other, centerless, and flat and surface grinders. So very strong spending within grinding. And then we get to the additive category here, and you can see that additive is significantly higher than the previous 3 years. And I take this to be a level of interest within the metalworking industry and additive equipment. There really is not a good way to forecast the level of spending on additive equipment at the moment. We haven't changed the methodology of doing that over the last 4 years. So this really does give you an indication that interest is significantly high in additive equipment. One thing we did do is add a new category for the kind of combination additive and subtractive machines, so those machines that do both milling and laser sintering. There was over $100 million forecasted for those types of machines, but given the number of companies that make those and how many machines they actually could make, there's no way $100 million will be spent on those, but you can see the interest is quite high. Within EDM, the wire type spending is going to be, or wire type machine is going to be more than half of the spending on EDM. That's pretty typical for EDM machines, and we're going to see an almost doubling of spending on RAM type machines. Within the screw machine market, about 60% of that market is Swiss-type machines, 30% multi-spindle, and 10% single-spindle. Within Swiss-type machines, 80% of that is CNC and 20% automatic. Within multi-spindle and single-spindle, it's almost all CNC machines. And then in the other category, we're seeing some particularly strong interest in just other type of machinery, either ancillary machinery or more dedicated machinery. So drilling and tapping machines, transfer and other special purpose machines, sawing and cutoff machines, and laser cutting. Those are all going to be up significantly. And then one final point here is that for the first time that I can remember in our survey, we didn't get a single respondent saying they were going to buy a gear cutting machine. It's only a single year. A single year does not a trend make. But I think it's interesting that result is taking place in 2015 when we're seeing more machining centers being used to cut gears. If we look at the major tooling types, we're also seeing a similar trend here of turning over milling. So a decrease in milling tools, but an increase in drills, and drills can be used in both milling and turning. And then stationary tool inserts, of course, those are used for turning applications, and those are up and increasing more than the rotary tool inserts. And then, of course, we see a significant increase in turning tools. So we're seeing relatively better performance in turning tools relative to milling tools. And then also in the other category, we're seeing some significant increases in saws and taps. In fact, taps are going to more than double in 2015 according to our survey. If we look at the major work holding categories, we see the milling and drilling categories up a little bit from 2014, but still down from 2012 and 2013. We are seeing an increase in automated systems and transfer lines, so that goes back again to the kind of special purpose machinery that we mentioned a few slides ago. And we are seeing a significant decrease in flexible fixtures. The one thing on the turning and grinding category, the reason those numbers are down so significantly the last couple of years is due to chucks. And I have not figured out why that is happening in our survey, why we're seeing a significant decrease in spending in chucks, whether people are just assuming those are coming with this machine or we saw an overspending in 2012 or 2013, but that's something to keep our eye on in years going forward. Now if we just focus on some particular industries, these are the top spending industries. These are all the industries in our survey in 2015 that plan to spend more than $50 million on machine tools. As you can see, job shops are clearly the #1 spending category, double machinery and equipment, and it looks like they're going to increase about 10% in 2015. 60% of all the job shops that receive our magazines do automotive work, and 52% of those job shops do work for the aerospace industry. So when you see strong spending in job shops, a significant reason why is the performance of the automotive and the aerospace industry. Within job shops, we're seeing big increases in small turning centers, VMCs, and HMCs, but the larger sizes of all those machines are going to be flat or down going into 2015. The machinery and equipment market, we're seeing a huge increase in spending here. The previous years, a lot of that spending was our very own machine tool industry, but this year we're seeing a lot of the spending coming from material handling equipment manufacturers, power-driven hand tool manufacturers, and packaging equipment manufacturers. Machine tool categories that are going to be strong in machinery and equipment, our small turning centers are going to be up big. BMCs are going to remain strong, and we're seeing significant spending in lathes, particularly small lathes. We're also seeing a sizable increase in the automotive industry. This is just a result of other motor vehicle and parts production. Unfortunately, we don't have specific categories that look like they're doing well there. A lot of the spending is going to be in the other category, although gasoline engines are still going to be quite strong buyers of machine tools. Within automotive, we're seeing big increases in grinding and small turning centers, and we're seeing strong spending in small lathes. Now the pumps, valves, and plumbing products here, that is really the energy industry is the way you should look at that, because the areas that we're seeing strong spending within that end market are metal valves, fabricated pipe and pipe fittings, and pumps and compressors. And this all has to do with both fracking, natural gas, and oil production within the U.S. We've seen that increase significantly the last couple of years, but they're in areas that are hard to get to and where there isn't a high demand for the energy itself. So we have to move that natural gas and oil around the country. And so all of the spending in pumps, valves, and plumbing products is for the infrastructure of moving that gas around the country. Machine types that are going to do well in that end market, turning centers are going to be up significantly, as well as VMCs and lathes. And then the forming and fabricating market also looks to be quite strong. Particularly strong end markets there are companies that do plate work, metal crown and closure stamping, and spring manufacturing. One final thing I want to mention is the die mold industry. We don't have that as a specific end market within the capital spending survey, but if we pull out the NAICS code within job shops, that is industrial mold shops, and we add that to custom processors, which those companies are essentially buying a machine to make molds, and add that to the plastic and rubber product category. If we add those three categories together, that gets us to about $932 million of spending on machine tools in 2015, and that's up more than 50% from 2014. And 2014 was up a similar amount or more from 2013. So we see the die mold industry is very, very strong right now in the U.S. market. And then last week at the forecasting conference that AMT hosted, there was a speaker on the tool and die industry, and she said that that's going to be quite strong for the next 3 to 5 years. And you can see the die mold industry would be the third largest end market on here if we presented it that way. Finally, some things that can cause some concern going into 2015 or may cause our survey to be inaccurate. One, the automotive industry has been doing well. Car sales have been increasing. But a lot of those car sales are the result of subprime lending. In fact, of all the new car loans taken out in 2015, 30% of them are subprime. Aerospace, the spending on the previous chart is also increasing machine tool consumption in the aerospace industry. And we've seen large aerospace orders recently. In fact, in the month of July, aerospace orders were at an all-time high. They made up 50% of all the capital goods orders that were placed in the month of July. Typically, aerospace orders average about 16% of all capital goods orders. So this was an extraordinary month for aerospace orders. Unfortunately, aerospace orders are notoriously canceled. The airline companies have to put their orders in with kind of an option contract to get in the queue for manufacturing, and when the economy changes, they're notorious for canceling those orders because those lead times are so long. Probably the most important thing to pay attention to is the end of quantitative easing, or is it going to end? There have already been some comments from several of the Federal Reserve presidents that maybe we shouldn't end quantitative easing and we should continue to buy bonds and other assets in this country. But if it does end, what is that going to mean? Are we going to see interest rates rise? Are we going to see the dollar rise? Are we going to see the stock market fall? All of those would be some cause for concern about our survey being correct for next year. And then globally, we see a massive real estate bubble in China that is beginning to pop, and a bond bubble in Europe. In fact, in Germany at the moment, I believe it's still the case that anything less than a 4-year bond has a negative interest rate, meaning that you have to pay the German government for them to hold your money. So we're seeing very, very historic low bond rates all throughout Europe, and that is some cause for concern because certainly many of those countries are not in good shape at the moment and would give you cause for concern in investing in their bonds. So any additional information that you may want, we do a monthly update on all of the leading indicators and what's happening in the metalworking industry. That's free. You can just send me an email and we'll add you to that list. You can find a lot of this information at GardnerWeb.com, and coming soon next year, we're going to have a new research website which will have a number of additional tools on it where you can check out my blog. So thank you very much for participating in the webinar today.
I'd like to thank all of you, and thank you, Steve, especially for your help in identifying these sales opportunities in North America. We hope everyone today finds the presentation helpful. If any of you would like detailed information on this survey or for specific technology categories, please contact your Gardner Business Media representative. If anyone listening would like to see this presentation again or share this presentation with another member of your team, a link to the recording will be available just after this event. This concludes today's webinar presentation, and on behalf of Gardner Business Media, we wish you success for the coming year and would like to thank you again for your participation. Good afternoon.